Greetings, Dr. Jeffrey Scott, and this is my weekend market update for September 15th, 2024. I bet nobody can guess where I'm at. I am in Baku, Azerbaijan, or something like that, where I came for the F1 race and having an awesome time. And that's why I didn't do this on Saturday. So apologize for that. I also apologize because I know my audio is going to be bizarre. I'm using my Apple iPod Pros, and I don't like how it comes out. But it's either I don't do one or I do it this way. So let's do it. So again, my name is Jeffrey Scott. My email address is hgsidoc@gmail.com. I'm happy to respond to comments. If you're new to my channel, hit the subscribe button, hit the alarm. You'll get noticed when I post these. If you like what I'm doing, hit a thumbs up. Let me know. If you got some suggestions where I can make it better, maybe everybody can benefit. So why don't you let me know that as well by responding in the remarks or sending me an email to my email address. It is a bizarre market, in my opinion, and I'm going to talk about it. I was going to call this about climbing a wall of worry or look out for buy the rumor, sell the news. But the reality is what we have is a broad-based rally with the Fed rate cut coming up next week. And let's take a look at the markets that we have and get some ideas about where we might be going. As always, everything I do is for educational purposes only. Anything I talk about should be taken in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. Several people have made some tools for me. They're awesome. I appreciate that and appreciate those of you that have purchased them. Anything I use, I pay for. And trading involves risk, and you are solely responsible for any investment decisions you make. If you like my videos, but you want them shorter, go to stocksanddocs.com. I put out a 5 to 10 minute video when I'm not traveling, so don't look for a lot this week. I think this is an error in this chart because I think this 0.9 is a misprint. I reran HGSI where I build these from www.highgrowstock.com, and I still saw the minus 0.9, but that doesn't look right on the charts. But the point I wanted to show on this is what a massively positive week. The NASDAQ, it was up, the composite, so everything was up. The dollar was flat. You could see the 100 was up 5.9, the Russell 2000 4.3, the Spiders 4%, the Dow 2.6, and the NYSE 2.5. I do think the big cap tech up until the end of the week were a bit laggards. Look at something like ARKK up 10% over the past 5 days. All the S&P sectors were up except for energy, which was down 0.5%. If we look at Friday on the Q Edge tool, looking at the S&P 1500 breadth for sectors, you could see all the sectors were up, all the industries were up, and 90% of the stocks were up. You probably made money. When we look at the distribution of the buckets, we'll talk more about it. We're starting to build a number of stocks above the Bollinger Bands, but we're not critical yet. If we look at that sector, industry, and stock, and we look out at 5 days, you could see it was a very strong week. 90% of sectors up and 86% of industry and 81% of stocks. Over 10 days, it's kind of a split session, but over the month, it's still a strong period of time. So we ran up, we fell back, and now we've had a nice little run. Have we seen the correction for September, or are we all getting sucked in for a major bull trap and the market sell off perhaps even before we get the Fed cut? Don't know. Just show you what I see and talk about it. This is the Q market breadth tool. Notice the series of Hindenburgs that fell on this composite index that includes both the NYSE and the NASDAQ. Might be the best way to look at it. And what happened? We sold off for a couple days, had a bottoming tail and a big rally. We had 2 indices giving us some accumulation on Friday. Very powerful. I'd like to see this eureka, which we've seen multiple times, to believe that this is real. If we look at the NASDAQ versus the NYSE, you could see that the Hindenburg omens were driven by the NYSE, and the NYSE was one of the accumulation indexes. The other accumulation index was the Russell 2000. So those are both very broad breadth indices. We can see rates continue to fall. It seems that after some of the weaker data at week's end, the market is expecting that we might see a 50 basis point cut. So one driver of a market sell-off could be a disappointment there. But frankly, if the Fed cuts 50 or more, it makes me wonder, what do they know that I don't know? Is this market actually worse than we think it is? If we look at, is there a recession? Well, the key slide here is the 10 minus 2, which has crossed above the zero line. And typically, as you can see in these gray bars, sometime after we cross above the zero line, we see recessions. Now, we haven't had a total breakdown in general activity, and neither are we having a spike in credit risk. But I think there's enough here to be concerned that because of that reinversion of the yield curve, or reversion to norm of the yield curve, that we still could be at risk at some point of a recession. My guess is it occurs after the nomination, excuse me, the election and then the induction of the president uh, of the U.S. in January. 13-week new high-low ratios entering a danger zone. When we get up to the top, we usually correct. We're up at the top. The stocks above the 200, stocks above the 40 are not extremely extended, and they're not driving my concerns. The T20 121 is. In fact, if you look back here, and this is the light blue line, you can see we're getting to extended areas across all the major indices. In fact, you can look also NYSE, NASDAQ, not so much because they've sold off so much. And even the combined index of the NYSE and NASDAQ is getting to an oversold area. Excuse me, overbought area. Here's the buckets looking at similar to the Q Edge tool, looking at the S&P 1500. And what you can see is about 12% of the stocks are outside their Bollinger Band. Clearly, there's a shift to more stocks above the midline. That's a bullish, but I would not consider this by any means to be overly bullish. And you could see that 60% are above their midline, 12% are above the top of the band. Now, here's the confusion part. These markets were super strong. I'm sure you had a great return this week. I hope you did. Most people did that I talked to. But look at both the NASDAQ and on the NYSE, and look at all those Hindenburg omen signals we've had over the last 2 weeks. It takes two to confirm, and 1 out of 4 times that you get a confirmed signal, you get a pretty significant pullback. It makes me wonder, how strong is this market, and are we heading for a disaster maybe this week with the extension by the new high, new low for 13 weeks and these Hindenburgs? Not saying we're going to fall, but it's got to keep you a little bit aware. If you look at the week that was, using the warehouse view and Edge Rater, looking at all the stocks, $2.50 and 250,000 shares, you could see that everything was above zero. And when we look down here, you could see there's a bit of a rotation into the weaker groups from the prior week. And some of those weaker groups were probably FANG-like high growth stock groups. And some of the interesting chart patterns as I went through my 1,000 charts on the plane over, I was in Barcelona at a medical meeting before I came to Azerbaijan, or however you say it. I'm still trying to figure that out. I looked at the charts in the air on that 5-hour lovely flight. So you could see great performance on the week. This week, we got retail sales, home builders, housing starts, building permits, jobless claims, and most importantly, we have that interest rate decision. I think the market's expecting 50 basis points. I worry that a disappointment could be the impetus that sets these markets to go lower. Now, here are the big earnings coming in. And actually, yes, nope, this is from last week. I take that back. Let me show you where I get these because that's not what I want to show you. So let's go into Twitter. So I got to open up my web browser. And is it just X? Sign in. Guess it's not called Twitter anymore. I'm sorry. All right. Pick an email address. Pick my PIN. Yes, it's not 4 dots. You know that. And let's get into it. Perfect. Opening up. And let's go into here and let's just type earnings whispers. Glad I'm not in one of those countries that block access to. All right, so that's September 2nd. That's not the week we're in. Here is September 9th, and here is September 16th. So you could see not as many earnings as we've seen over the last couple of weeks coming to the end of earnings seasons. But fear not, we still have plenty like FedEx and Lennar. So I guess we're probably about to start another season soon. As I say in the slide, it is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Thoughts, we had a nice rebound after the previous week's big declines. This was clearly by the dip was back in force. Look at the mega cap index up 5.5%, semis up 10, Nvidia was up 15. CPI spooked the markets a little bit. By the end of the day, they recovered. And as I've mentioned, despite the enthusiasm of the bulls, wonders if we are heading into the buy the rumor, sell the news on the rate cut. We've had 4 Hindi signals on the NASDAQ and NYC common over the past 2 weeks, and this cannot be considered something good for the market and raises some of my concerns. Plus, that 13-week new high, new low is sort of the old reliable indicator I use that show that we're going to set up for at least a minor sideways move, pause, correction, but we don't usually get more extended when this thing starts to fire. So how am I positioned? I may remain long in the market. I've got stops in place. What I do with my calls in times like this is I don't want my calls to be sitting on a lot of profit. So I will roll my calls up. I might have to sell something against my call when I roll it up to defray any cost, which means I'm taking money out, I'm pushing my strike price higher, and I'm typically pushing the expiration date out a month or two. That way, if the market crashes, I don't have a whole lot of fat intrinsic value to my options. I've got a number of positions. I'm not margined up because I'm worried about what this market's going to do. And I will tell you from a bottoms up perspective, I was impressed by the number of good looking stocks in this market, but many of them look extended. So again, if you like this, go to stocksanddocs.com. There's no charge. I don't try to sell you anything. And come take a look at my daily videos. So now let's go on to the charts. So I use a number of programs, and I'm going to look at the market indices different this session. I'm going to look at them in TradeStation. And the reason I'm going to do that is because I really like the auto trend line that is placed by my buddy Cigar Nandy. And I think he calls it Q memory lines. And I think it tells a story that's important. The theme so far is, boy, this market's been great, but I think we got risk coming in despite the fact we got a Fed pivot and a cut coming later this week. So the first thing I want to show you is the E-mini, or we could look at the S&P 500 in the cash markets, and there's an auto-generated trend line that we are coming right into. We could not get above it here. We could not get above it there. Let's see if we can get it above it now. Now we have an ascending triangle here, and maybe that's a more bullish scenario than just coming up to resistance, but that's something we have to break through. Notice the Q's got the same problem, more of a wedge, trading up to the top. Now what happens typically when you trade into resistance? Well, it becomes a point that you might see some kind of a reversal. If you look at the diamonds, you can see the diamonds look much better with no trend line resistance above, still in an uptrend. And if you look at the Russell's trying hard to break above this downtrending trend line. But again, the Russell, the Spider, the Qs are running into an area that might be considered high risk from the perspective of resistance. And when you put that together with the Hindenburg omens and some of the other things I mentioned already, I think it sets up a period of concern. Now, if you look at, let's flip back into wealth charts for right now. Nope, not that one. Not that one. We flip into wealth charts and we look at, let's go back to the 5-minute charts for a minute. You could see on the week, here is Monday, gap up. Tuesday, gap moved higher. Wednesday, a big gap down on that CPI, which we quickly turned around and said, well, maybe it's not so bad. And then you could see Wednesday, Thursday had a massive rally. And then Friday, we kind of coasted to a finish. And so that to me is a very bullish looking response to the market. Now, if I remember correctly, let's see if that's the case. Yeah, this was a potential resistance zone that we identified back in August 30th, so not too long ago, really 2 weeks. And it's interesting, that was the close of the week ending there, that all we did is we pulled back hard and pulled back to where we had failed at. So that's interesting to me. Right. So just very quickly again, the spiders have broken above most of the resistance. Here's that resistance concern. Did have the 50 as support, had a big move on Friday up an additional 0.52. If we look at the Qs, I would say the Qs are in a nice uptrend, um, getting back above the 50. Now you could certainly come in here, and this is the line to be concerned about. Will that be resistance and cause the market to roll over? On Friday, the Qs were up 0.45%. Cool. Let's look at the diamonds. Clear-cut leaders right now, and all right, let's bring this up. We can look at the diamonds and see again a nice breakout just below all-time highs. Great volume, looks great. What else do we have? The Russell, which I had that yellow box remind me that the all-time high was back in November 8th. We have taken out the 50. We're in this area of resistance. And like we saw in TradeStation where it was generated automatically, and yes, I'm a little lazy and I like automatically generated trend lines. Clearly got a trend line right here, which, hey, we are at or near at and going to go in and hit on Monday. Will that be resistance and lead to the market pulling back? If I look at a weekly VIX, last week it expected to have done negative and it was down 26%. And the dollar is sort of bouncing off support. Looks like it was probably down on Friday, but reversed and closed higher than it opened, thus giving us a green candle. Commodities are interesting. Dollar has been weakened. So what do we find out? Gold is at all-time highs, or at least my data highs, 1.76. Silver, which has its own trend line to worry about. Oil, so gold, silver doing well. Um, Oil, not so well. Um, Silver, I was going to draw that trend line, and I am sleep deprived, and I had a momentary nap. Let me draw that line in now. I mean, there's a, I figure out where that line belongs. Probably belongs starting here, taking out that. So we're coming into a potential resistance line on silver. Oil has dropped hard, really at recent lows. Natural gas has not given us its seasonal bounce, and even the 10-year is soft, bouncing around at its recent lows down 0.6. We go and look at my weekly market timing model. Let me just tell you, I'll give you my thoughts. We've got two things that remain in a long. You stay in a long until both you close below the WMA and you flip your bongo. We have never gone to a sell yet in the spider. I put a yield sign there and we reversed higher this week. I put a yield sign on the weekly Qs. We are technically in a sell signal, but we reversed above the WMA. So I'm on buy watch there. If we look at the Russell, Like some of the others, we broke down and went to a sell signal. But on the weekly chart, we broke above the WMA on Friday, and therefore I put a yield sign there. And then if we look at the diamonds, like the spiders, it's never gone to a sell signal. So I got two sells, two buys rather, two weak sells with yield signs. Still tells me it's okay to be long. If I look at the S&P 500 sectors, you could see that some of the stars last week aren't stars anymore. XLV weakened in the end of the week. XLP weakened end of the week. Real estate didn't weaken much, but look at the strength in industrials, and even technology and discretionary picked up. So a little bit of rotation to some of the tech away from some of the lesser risk staples. We go to the Scott scanners and we start with the heat map. And I mentioned that some of the big cap techs were looking good. Let's take a look at some of them. Also, don't look at the red versus green on the heat map. Look at what the chart did, because these things in the heat map don't close until the end of the after hour session. So they could be a little different. Like, for example, but it's not in the heat map, but Summit traded up after hours. So it's going to look different between the heat map and the chart. Let's start with Meta. Meta is this kind of a head and shoulders pattern in here. It had a double top-ish looking pattern, pulled back and held at the 50 and now took out the 17. Coming out of the squeeze, or Meta looks interesting. Apple sitting there right on the 50 in a squeeze. Hasn't moved yet, but that looks interesting. Certainly worth watching. Tesla breaking out there. I saw some upgrades on Tesla coming out of a squeeze with good relative strength in OBV. NVIDIA said it had a big week this week. You could see it came back up, took out the 50. Can it run up to this trend line? Perhaps. Not sure how far this is going to go after last week's move. Microsoft, interesting buy point, just took out the 50. Only green dots, relative strength of OBV looks good, not extended. Adobe, this was a loser in big cap tech, probably on earnings the night before. So let's see what the earnings look like. 465 versus 453. Clearly, they must have given some negative guidance forward or missed a whisper number, because those are good earnings. You can see it sold off 8.5%. Amazon, this has been a laggard, and it had a major move this week, taking out the 50. Lots of green dots coming out of the squeeze. Relative strength and OBV look good. And what else do I want to look at in here? Google, this is the laggard, struggling at the 200. So, and then lastly, let's look at Netflix. So looking at a bunch of these big cap tech names, you can see some of these are looking actionable. A new EMS signal on Netflix, a breakout dot out of a squeeze with good relative strength and OBV and not extended. So big cap tech is starting to look juicy again, selectively, but they look better. If we go to Wealth Scanner and see if we have any change from the very defensive that we saw last week, and we see what comes up to the top: bonds, 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 utilities, defensive, real estate, bonds, 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 bonds. I see a story there, which is it's still defensive looking if you look at some of the perhaps slower moving than the chart. Um, Notice that we got a bunch above 800 that we didn't have before. That's a little bit more bullish, but I'm not sure it's that bullish when what you're seeing are a number of government bonds. So if we go to the CAT scanner and let's look at real estate to see if anything is actionable. I think I saw a couple on my reviews. So we'll look at that. We'll rank it by dots. Camping World Holdings, kind of a jumpy chart, but let's make it smaller. So you have a stock that's fallen back, sort of giving you a saucer bottom, It's just broke above the 200. It's not an optimal stock. There's not an uptrend with a pullback. It does have volume breakout momentum, good relative strength in OBV and not extended, so it might be worth watching. Cushman and Wakefield, one of these real estate services companies, nice uptrend and a recent pullback to the 50 and a big move up on Friday. I like that pattern. Brandywine Realty, similar pattern, but probably more pronounced the way the chart is, but sort of stepping up to higher highs and higher lows. Broadstone Net Lease, no idea what they do, but a beautiful uptrend, pull back and breaking out. So we can see that there are a number of real estate stocks that look interesting. Kilroy Realty, several of these also pay dividends as well. Again, this looks like the first one. It's not exactly a high growth stock that's given a little pullback. This guy pays a pretty significant dividend and doesn't do anything. This is Alexander Real Estate. This one's just breaking out on Friday. Why I say it doesn't do anything, because look at the weekly chart. It's gone sideways really since March of 2023. All right, so we looked at real estate. I'm not really a bond chaser. So let's take a look at the combo buy list, large list of stocks that I thought were good enough to look at again. Excuse me. I've been not sleeping much on this crazy trip. So let's see what we got. Laureate Education. Nice gap. As you can see on the weekly, it has been in an uptrend. And look at that. It had a Rob Hoffman launch indicator, a wealth signal, lots of volume, 4 dots coming out of a squeeze. Relative strength in OBV, it looked good and not extended. That might be one to look at. Align Technology, it's below the 200. Not my favorite place to buy, but you can look at what it's done of late. It has higher lows, and perhaps if you can get above this level, higher highs, and it could run, another 4 or 5% into that 200. AUPH, biotech, big move up, pull back. Something about this I didn't like when I looked at the stock. Checkpoint looked interesting. Massive leader, pull back to the 17 and running again. There's your Cushman and Wakefield. I also like Shift for Payments. And so you have a stock that's in an uptrend, pull back to the 50 and it's breaking out here. IBB, the biotech index looks particularly attractive, and IBB shows a EMS signal, volume breakout momentum out of a squeeze, not extended, with decent RS and OBV setting up, off of the 50, taking out the 17. I like that a lot as well. So, notice how I'm finding attractive stocks, and I'm really not doing a whole lot of work here. I'm basically letting the scanner bring the ones I like up to the top. Now, let me just go to my buy watch list. This is going to be a relatively quick one, but the audio is not great. And I fell asleep once doing this. Just tells you how tired I am. I got to go to bed. So let's look at the weekly buy list. We looked at Amazon. Arista Network, just look at the weekly. It just likes to go higher. You've had a little bit of a sideways movement here, breaking out off of the 50. AppLovin, one of my holdings, had a beautiful breakout this week. Looking at the fundamentals, I don't feel the need that I should be selling it, but very impressive move. But that's just my opinion. Education, I don't know what it's going to do. A lot of building related stuff looked interesting. Here's AZEK, building and construction stock. Maybe on the supply side, you could come, hold on, let me get that all the way. Might be able to sit up here and take out that and say, hey, I kind of broke through that trend line resistance on Friday. That might be something that's interesting. BLDR is another building supply company. And you could see a big uptrend and a pullback breaking out here over the 200. Not much in the way of dots, but relative strength and OBV look good. Cruise lines, whether you look at Carnival or Royal Caribbean, Carnival is pulled back as a cheap stock, where Royal Caribbean is a much more higher price stock, but look at that beautiful uptrend. IDCC, sort of a digital royalty patent company that I can tell. I love the pattern, big uptrend, pull back to support and breaking out here, like that a lot. The home builders look great. This is KBH, just pickers. They all look the same, obviously getting um, benefits if we see lower interest rates. Lanthus intrigues me. Does what's called radioligand therapy and some diagnostic testing, and they had some good news here that led to a big run up. It pulled back, sitting on the 50, maybe hasn't broken out yet, but that's the kind of thing I like to see, the kind of pattern I like. So that's something I will be watching. KKR is one that I currently own. There are a number of asset managers that look really attractive here. Um, so nice uptrend. I picked the one I had, but Apollo was another one, TPG, etc. A lot of these are stocks I just reviewed with you. I mean, gold looks good here. The question is, which is your best bet? I like Newmont here, NEM. You can see breaking out to a recent high, but there are many. New is a banking, I think, technology story. Nice uptrend. Here was a stub the tub, and now moving higher. I think that's it here. So I've looked at the markets, which I think if you look at them on face value, they're doing amazing, but I'm worried. I think that's pretty clear. I've looked at where the leading groups are, and we saw things that are defensive, which goes to being worried, the 13-week new high, new low, and the Hindenburg. Yet, why am I so bullish? Because my timing model tells me to be, and you got to look at the market. So I'm going to remain pointed to the long side, and I am going to be very careful, and I'll be quick to exit and take profits. There's nothing wrong with putting money in the bank. Again, if you buy a call and it goes up a lot and you're sitting on that call and the market corrects and the call drops, you could wipe out any of the profits you picked up. You roll it up to a higher strike price, you put those profits in the bank. Something to think about as we go into what could be an interesting week in the markets. So what else did I wanted to show you? I wanted to tease you a little bit and introduce you to a new tool that I'm working on, which I call Market MRI Pro. I am a giant fan of wealth charts. That's why I use it all the time in these videos. But I know that not everybody's bought wealth charts, and maybe somebody's looking for an all-in-one tool that just does the stuff that I do. So what I've done with my partner, Praveen, or should I say Praveen has done based upon my methodology, is we've developed a tool that is a top-down analysis tool. So let's just start with the charting aspects. So I've created something I call JF, which is Jeffrey Force, which I'll introduce when we introduce the product as a way of ranking instruments. And as I look at this, so many of the stocks that I like come right to the top. But I'm a top-down guy. A top-down guy doesn't say just look at the best things in the market and buy from there. You could, and you could look at the ones that came up that showed a lot of buying pressure. And I'm on international internet. It's not great, so things are a little slower. But what we were able to do is we were build a industry group model where you can pick what industry if you want to look at. If I ranked them by J Force, look at cyclicals. These are the stocks in cyclical, and these are some of the leading stocks by J Force: Bookings, Restoration Hardware, Melly, DEC. And so this tool allows you to take a gigantic list of stocks, and here are 33, 34, which include all the stocks in the U.S. market, I think above $2, over $1 and 100,000 shares. We've assigned them all to industry groups and sectors. And by doing that, we're able to look through a top-down lens at the sector, then the industry group, and then look at the stocks. Or you can look at just the sector as a whole, and we're looking here at real estate, and the leading thing by J-Force is real estate development. We can come down here and we could take a look and see if these have anything of interest. Smith Douglas Homes, maybe breaking out. FOR, I don't like buying things that far below 200. LSEA, maybe getting interesting. So nothing I really like there, but you have the ability of going through sector to industry group to stocks, more on this to follow, and all the same indicators, the high-low jump, the bongos, the dots, the relative strength versus OBV, versus a spider OBV versus a 10-day EMA, 10-period EMA, and then my timing model with the new line, which is the signal line. And here's the signal line that says I should still be long green, the spider, still long the diamonds. And although we have sells on the Qs and the Russell, I am aware that we had massive weeks taking out the WMA here. So we have to see. So where am I going to leave you? I think this is a week to be careful. The market's likely to react. I think everybody's expecting the market to go much higher after the Fed cut. I'll just point out that we still got those Hindenburgs. We still got extended markets by the 13-week new high, new low. And the first Fed cut does not always lead to market um, going higher. Have a great week. Sorry for the time I fell asleep in the middle of this. Sleeping is something that's you need to do, and I'm going to go sleep right now. Have a great one. Thanks, everybody.